Welcome back to Pathways to Wealth. In this episode, I am interviewing Jon Bassett about a market and an industry that I am super passionate about and that I see a lot of potential for both entrepreneurs and investors. And that is the tech startup space, angel investing, and venture capital. And we're interviewing Jon Bassett, who's actually a friend of mine and the managing director for Nextgen Angels here in Austin, Texas. So Nextgen is a nationwide angel investment network that deals with some of the most prominent angel investors in the world, as well as some of the hottest startups. And the deal flow coming through Nextgen is just mind-blowing. So I'm really excited to kind of introduce you guys to Jon because he started off as a trader and then started a gardening company that's still operating today. Really interesting story. And he went into the venture capital world and worked with VCs for a while and now does what he's doing today. In this interview, we talk a lot about the common success traits of startups because Jon sees a lot of companies and why so many of them fail. So this is just a really deep look inside of the angel investing and venture capital space. And you'll also, we're going to talk about the question that's kind of on everybody's mind, which is the startup community or is this market in a bubble? So without further ado, here's Jon Bassett. Hey guys, welcome back to another great interview here for Pathways to Wealth. Today I have a really, really special interview. Jon Bassett. Jon, how you doing, man?
Doing great, man.
Thanks for being here.
Thank you for having me out.
Yeah, man. So for those of you that don't know Jon is the managing director of Nextgen Angels here in Austin, Texas, which, Jon, let's just kind of explain what Nextgen is.
So Nextgen is an early stage venture capital firm. And we sort of build through a group of venture partners. It's a bunch of young tech-focused folks, mostly tech founders and executives and sort of prolific angel investors. But the emphasis is really on young folks that are involved in tech. We come together and look at early-stage tech deals together. And then as a group, we decide whether or not we want to invest in a company. And we typically pool about $250,000 and make investments into early-stage companies.
Yeah, that's awesome. So I just actually met with Jon, a few months ago?
A couple months,
or was it earlier this year? I can't remember, but I was like really impressed because I'm just getting into the angel stuff, and I've tried some other groups and looked at other networking ways of just getting deal flow, and nothing was really that impressive. But kind of the idea that you have of creating young like tech entrepreneurs and tech angel investors like just really resonated with me. So the deal flow that I've seen has been great. How did Nextgen get started? It started in like DC, right?
Yeah, it's actually a pretty interesting story. So it was started by two Harvard Business School grads, Brett and Dan, who at the time wanted to do more early stage tech investing. They had full-time jobs. They met with most of the angel groups on the Eastern Seaboard, and the angel groups they met with tended to be, they trended a little older, folks that were retired and a little bit out of the tech community. A lot of people with money, so doctors, lawyers, dentists, looking for different types of businesses, not looking for the early stage tech deals, right? Mm-hmm. And they sort of said, hey, this isn't our people, this isn't our tribe, this isn't the type of deals we want to do.
Yeah.
So let's start doing it on our own, right? And so they got together with some classmates, some buddies, and sort of nights and weekends, they built this informal group of 25 guys and gals that looked at deals together and made investments together. Over time, the model sort of got some traction. Folks in the group said, hey, I think this could work in other cities. Let's go build this out and expand. So we took some investment into our operating company, scaled up the team, and now we're in 5 cities. So DC, Boston, Austin, Chicago, and New York City.
It's awesome, man. I love it. So let's talk a little bit about your background. So this is what you're doing now. You come from finance and VC world and trading, and let's just start at the beginning.
Yeah, so I guess I've done quite a few things in my short work career, if you will. Started working pretty young, grew up in Iowa, went to school in North Carolina at Davidson College and played soccer there. Actually took my first job right out of school at Dell Computers in a management training program. You do 6-month rotations in a bunch of different fields, marketing and sales. And I did my first couple months in consumer sales, inside sales. You're on a bullpen floor of 300 people, taking calls, people wanting to buy $200 laptops. And so that was really great training, learned a lot about selling in that forum. But after about 3 months, I decided it wasn't for me.
Yeah.
And so peeled off. And to make the story a little bit short, I had a good friend growing up who was a pretty active day trader and sort of earned his stripes, long short U.S. equities, trading stocks, and day trading. And so he said, look, I think we've got something here. He audited his 4-year kind of track record. And so why don't you come join me on the sales and marketing side and help me raise some capital? So left Austin, moved to Seattle, and we started a fund called Calum Capital, raised a little bit of cash and did that for about 2 years out of Seattle.
So what kind of trades were you guys looking for?
Yeah, so it was we did some earnings trading. We did we used 4-to-1 intraday leverage to really kind of juice our returns, which can cut both ways. We were kind of 50% long, 50% short. Certainly not afraid to go short or do naked shorts. Tight stop losses, but mostly sort of U.S. equity stuff, technical analysis, charting stuff. So did that for sort of 2 years. It was a volatile time, 2008 to 2010. I mean, the financial collapse. I'm sure a lot of your listeners are aware of that.
Yeah.
But decided that we wanted to take a little bit of the proceeds from the fund and do something totally different and start a company totally different. And so moved to Los Angeles, started a company called Farmscape Gardens. At its most basic, we build and maintain vegetable gardens for homeowners, schools, and businesses.
Interesting. So you would go out and physically build the garden for them?
Yeah, and the emphasis is really on maintenance. Most folks had a garden or had experienced gardening growing up, but it's actually hard to maintain a garden because if you neglect it, it dies, right? Yeah. And so we spent some time looking at the data, and 2 of the largest leisure activities for adults are actually genealogy and gardening. And if you think about it, Ancestry.com has sort of a lock on the genealogy space, $1 billion plus market cap. In the gardening world, there's no one brand you think of, right? No consumer brand, no company that kind of has national appeal. So we really aimed to build that and improve urban food systems. So it really started with a mission in a big market and evolved into this, where can we actually differentiate? And that was the maintenance piece. So we've got a staff of gardeners in LA and San Francisco that go out on a weekly basis, maintain vegetable gardens, harvest the produce, leave it on your doorstep. We actually maintain the giant baseball team, Giants, AT&T Park. So we maintain the vegetable gardens at AT&T Park. We've got some bigger name, more established gardens, but that company's still alive and well.
Do you have an active role in that company, or did you kind of?
So I'm on the board, and that kind of is a funny transition. So through that, I actually got to meet a guy named David Kremen, DFJ Frontier. They're a venture capital firm. And his wife is very active in the gardening community in Los Angeles. And so met her through my role at Farmscape. She did some grant writing and some nonprofit work in the gardening space, built a relationship there because Farmscape actually installed and maintained a lot of the gardens that she did grant writing for. Started to meet her husband, who is a venture investor, and sort of pitched him on, hey, I've done this entrepreneurial thing. I have some experience in sales and marketing. I spent a little time in the hedge fund world. Are you guys looking to hire? And he said sort of, hey, you're kind of naive kid. Like, I talked to hundreds of people. They all want to work in venture, and it's really hard to get a job, right? Yeah. And so I sort of said, what do I got to do? And he was like, well, here's kind of a day in the life, and start diligencing deals. And he sent me some stuff to do, and I did it and started showing up in the office. And sort of over 6 months, I worked unpaid part-time, helping run Farmscape and doing the stuff at DFJ Frontier. And the relationship sort of blossomed and snowballed. And eventually I said, hey, can I come work for you guys? I like this even better than running my own, company. So made the leap to DFJ Frontier and spent almost 3 years there helping them do early stage venture investing.
So from salesman to trader to gardener to venture capital guy.
Yep. It's quite in a rather short span of time, honestly. There's kind of a theme that runs through it all. I mean, I've always sort of enjoyed the entrepreneurial pursuit and sort of running my own business, so to speak. And all of those things really were that. I mean, in inside sales at Dell, you're kind of a direct contributor, individual performer. To the sales and marketing function in a hedge fund. You either raise money or you go out of business, right? So you're kind of controlling your own destiny there. To the gardening world where, again, we saw a need and a problem and wanted to fill the solution. We have a great team, and that business is alive and well. And then sort of opportunistically into venture where your job is to sort of be a steward of limited partners' capital, invest in great deals, and return more money than you took from them, right? And so there's kind of a thread that kind of runs throughout, but I don't know many people that can say they've, done sales, trading, gardening, and venture capital in a 8-year, 9-year span. So
that's amazing. So what brought you to Austin? Because that firm was out in California?
Los Angeles, yep.
Okay.
So DFJ Frontier is based in Los Angeles, part of the Draper network of funds. And actually, I got recruited to come join a venture fund here in Austin called Silverton Partners. They're an early stage venture fund here in Austin. And so made the leap, actually knew I wanted to get out of Los Angeles. Great city, but didn't kind of fit with kind of my personal goals, buying a house and having a big yard and doing all that. So decided to make the leap to Austin and join Silverton Partners. Spent some time there, and then this group Nextgen sort of sat down with me while I was at Silverton and said, hey, we think we have a better model for venture. Convinced me that what they were doing is really meaningful, and I could have a meaningful kind of stake in the outcome of the company. And so as of June 1, this year, joined up with Nextgen as the managing director of Austin, and kind of helping grow the network. And the vision is really to be in 10 plus major cities in the U.S. and probably 3 plus cities internationally, and to really be a scalable sort of network driven model. And getting guys and gals like yourself, the model is really build up a 100-person venture army in each city. You help us source deals and diligence deals, and sort of the best stuff flows to the top. And then we as a group decide what deals to do, and out of our fund, which deals to invest in.
Awesome. So from trader to gardener to venture capitalist, now you're running a really just incredible kind of next level, next generation angel network that I think is just really cool. Let's break it down and do like an explain like I'm five for what angel investing is, because a lot of people that watch this show are either traders, entrepreneurs, or investors, and I feel like angel investing is becoming more popular, and with the new the Jobs Act that's opening that up a little bit. What is angel investing, and why do you think it's important?
Sure. I don't actually know where the term came from, but I have to imagine it has some religious connotations. And angels are the saving grace for early stage entrepreneurs who are trying to quit their jobs or make it with their company. Yeah. Angels typically are kind of the earliest stage of capital for a business, right? And so if you or someone else has an idea to start a company and aren't fortunate enough to be able to self-finance it or bootstrap it, which means you don't raise any capital and sort of the revenues of the business keep you profitable and help you grow, typically the first stage is you approach friends and family first, right? You say, hey guys, help me out, throw me a bone.
Friends, family, and fools, right?
Friends, family, and fools, right? Yeah. And so angels sometimes fall into that camp, typically maybe a step right after. But let's take a typical deal, right? You've got a harebrained idea to go change the world in some way, right? You need 50 grand to quit your job and have 6 months of runway to sort of hack away. You get that from friends and family. You start to get an inkling that you have a good idea. There's some market validation, some early traction. The next step is typically to raise, $200,000-300,000 from angels. And angels typically write smaller checks, anywhere from $5,000 or $10,000 up to $25,000 to $50,000. You get much bigger than that, and you're kind of in the super angel camp. Mm-hmm. But typically in a round of a couple $100,000, it's the next stage of financing for a company, right? And then from there, you'll go out and raise $500,000 or $1 million, and typically start to enter the super angel or VC world. And from there, it's kind of off to the races with venture capitalists and private equity and beyond.
There you go, man. So it's just kind of a progression, and that's what I think is cool about angel investing is you get in when it's early enough that sometimes you have proof of concept, sometimes you don't. But like you said, you're usually investing in either the entrepreneur or kind of the harebrained idea.
Sure.
One of the last deals that I got in on was actually an A round. So there was venture money in there. Is that typical? That's actually something that I don't really know the stats on. Is do angels typically invest more in seed rounds, or kind of a mix between that and A rounds, like after you have the seed capital and then you're raising real money, like multiple millions of dollars? Where do you think angels typically fit in that space?
Yeah, angels are typically the kind of the first serious money in, and that's typically before an A, right? And so sort of the vernacular has changed over time with venture rounds. So angels are typically involved before there's true sort of market validation, right? It's still maybe a couple guys and gals and an idea, and they need some more money to really hire up, build more product, do sales and marketing, a few other things to prove they really have a business. Yeah. And once the business is sort of proved out, angels will typically follow along in what is called pro rata. They have a right to maintain their ownership in the company per a term sheet typically. But they usually get involved before the Series A. And once a company's raising $2 to $3 million or more, angels start to sort of die off, and the big boys start to step in.
Nice. So what advice would you give to somebody that's like, man, that sounds great, I want to become an angel investor?
Yeah, I think the first piece of advice would be don't angel invest with money you can't afford to lose.
Yes.
both for financial reasons, but also mentally afford to lose. I think that's a totally separate issue, and people sometimes think they're ready to lose money until they do and then realize how distraught they are. The second thing is most financial experts sort of recommend you build a portfolio of early stage investments if you're going to do it. I'm certainly not a financial advisor, but I think the wisdom is anywhere from 2 to 5% of your net worth should be in sort of alternatives, of which private equity, venture capital, angel investing
basically
falls
really
into.
high risk stuff.
Very
right?
high risk stuff,
Yeah.
right? And so if you're going to do it, I think you really should plan to do a minimum of 7 to 10 investments. So you actually build a small portfolio. And basically whatever amount of money you can carve out for angel investing and afford to lose, you should really carve it into almost 20 chunks. And the thought being you invest in 10 companies initially, but inevitably, unless you hit just an incredible deal, the company's going to need more capital over time, right? And so you don't want to be left out of later rounds or the ability to maintain your ownership stake because you invested all your money in early stage deals and couldn't follow on, right? So if you got $100,000, break it into 25K chunks. Put $5,000 into 10 companies, so you've sort of done your first $50,000. And then as those either go out of business or grow, sort of pile into the ones that are growing and make sure you maintain your ownership, because inevitably 1 or 2 will be the big winners and generate the bulk of your returns.
Yep.
And you want to plow more money into those, and then obviously put less money or no more money into companies that aren't performing well or are likely to fail.
So don't go, like, say you have $100,000 that you're like, I want to use this as my angel investing capital. Don't go, I love that company, here's $100,000, and just basically like hope for the best, right?
That's probably the worst thing you can do. And I somewhat blame the media today and sites like TechCrunch and otherwise. There's sort of this hyper excitement around the deals, but what people don't hear about is the ones that didn't work out.
Yeah.
It's easy
What percentage is that, by the way, if you had to say, like companies that don't have an exit, like get acquired or go public or some kind of liquidity?
So I don't know the data. I think the last thing I read is the average time from initial check to exit is 7 years. So it's a long time horizon. That's average. There's some
this
that
isn't day trading here.
There's some that take 14 or 15 years. There's some that get acquired for their talent or otherwise, a year or two into the business. But plan to be in a deal for 7 to 10 years, and you probably won't be disappointed. I forget kind of what the question was again here. I kind of got off on a tangent. But
no, that's fine. Yeah, success rates, right? Like, like most of them are going to fail. And I feel like just from my very limited experience in the space, it's not the ones that from the beginning that look like the home runs in the early stage that always make it. Sometimes it's the ones that don't look that promising, or people kind of look at it and go, I don't know. And then all of a sudden the market shifts or whatever. And then that's the unicorn, or that's the one that crushes it. So are there any deciding, any important criteria or deciding factors that you look at whenever you look at an investment or whenever you're trying to do due diligence that says, yeah, this company has a real shot at making it big?
Sure. I think, my theory, and I think a lot of other people's isn't unique to me, but you want to bet on the jockey more than the horse. And by that, I mean that the team is really all that matters. Like, I can honestly tell you in all the deals I've done in venture in the angel world throughout my career, no company has successfully exited doing the exact same thing they were doing when we gave them the first capital. And so inevitably, the term I think people like to use is pivot. But companies tend to change what they're doing when they get feedback from the market, from customers, and they're never doing the exact same thing when they get bought as they were doing when they initially raised capital. And so you need the right team in place to navigate sort of the ups and downs, soliciting feedback from potential customers, making the right decisions. And my real belief is a company succeeds or fails on a million little decisions, not one big decision, right? And so people think, they always want to sit down with successful CEOs and say, man, what was the 1 or 2 things you did that really made this successful? And I don't believe there's ever 1 or 2 key things, right? It's the building block of a million different yeses and nos, or do this, don't do that. And when you add them up, it's the in aggregate decision making that makes a company succeed or fail.
Absolutely. Yeah. So I guess another way to put that is maybe ideas are a dime a dozen, but execution is everything, right?
Absolutely. Yeah. And to really answer your question about success rate, I think if you look at a portfolio of 10 deals and in the early stage angel stuff, I think you should probably plan on 50% of your deals just going to zero, not getting any money back.
Okay.
In a portfolio of 10, you really want 1 to be an outright success and return the capital you invested in the other 9. So to really get all your principal back. and then 2 to 3 of them, you get your initial capital back. Maybe you make 2 times your investment. But really, most people who do this are playing for the outsized winner. It's not singles and doubles. It's grand slams and strikeouts is what you're going for as an angel. So you got to have enough investments to get the at-bat percentage that you need to hit a grand slam.
It's a great way to put it, man. It's not like, you go in on one, hope for the best. It's you diversify, and hopefully one of them makes it big.
Yep. You're going for slugging percentage, not batting average.
So what was your biggest challenge in like starting with the Nextgen thing, or let me actually ask it this way. What's the biggest challenge that you run into when doing your job, looking at deal flow, trying to raise money?
Yeah, I think a couple challenges. One, I think angel investors are a very necessary part of the ecosystem. They're the ones who sort of kick things off and get companies in business. They're the very early believers when there's nothing there to really believe in, right? Mm-hmm. But I think one challenge is that over time, some angels, like the term angel, has maybe gotten a bad name or a black eye because of individual bad actors. When as a group, people typically have good intentions and do the right thing. And so I think sometimes we're fighting an uphill battle with the term angel. And actually, as a group, we're trying to drop angel from Nextgen. So going from Nextgen Angels to Nextgen Venture Partners or Nextgen VP, and really emphasize the fact that we have a fund in place. That's not a general solicitation for fundraising. And
full disclosure.
Full disclosure. And that we are really trying to be an early stage venture fund that happens to aggregate a bunch of really smart, technically focused people that can help sort of inflect the course and speed of your business versus being a true angel group, which I think can sometimes have perceptions of dragging things out, putting weird terms in a term sheet, over-promising and under-delivering. And so I think that's been the main challenge, right? I think the second thing is we're in a period where there's sort of record amounts of capital flowing into early-stage deals. And so when there's an excess sort of demand for deals versus supply, you see prices increase, right? Mm-hmm. And so a deal that you typically could have got in on a more fair valuation, valuations are up 1.5 to 2 times for the same stage company as they might have been 2 to 3 years ago. And so right there, the bar to get a return has doubled, right? So you have to do twice as well now from where you would have had to do before to even generate a return on your money. So that means you have to be more selective and you have to be better at sort of separating the wheat from the chaff in terms of like good deals versus mediocre deals.
Do you think we're in bullish exuberance and, dare I say, bubble? Or do you think there's a reason for the flow and the state of this space?
There's smarter people than I that should really speculate on this stuff, but I do think when you see groups like Fidelity and huge public market money managers entering later stage venture, private equity almost, I think it's because they're not able to generate returns elsewhere, so they're able to take more of a flyer on private market deals, right? And because interest rates have been so low for so long, they've got to find a return somewhere else. I do think that there has been a bit of exuberance. I think we're not in a period that we were in 98 or 99, which I wasn't in this field then, right? I was much younger, but from what I hear from those that lived through it, companies were going public on a domain name only, right? Like pets.com had a crazy valuation on almost very little revenue just because people thought the name is what mattered and you would sort of build into your valuation, right? Mm-hmm. If you look at the IPOs of the tech companies today, the boxes of the world, like you're not seeing irrational sort of exuberance. Maybe the PE multiples are high, but I don't think they're undeservedly so based on the new SaaS model and some of the revenue frameworks in place. So I think valuations have definitely creeped up. We are at a time where capital is easy to get, which means that relatively speaking, easy to get, which means that valuations are going to creep up and you have to work harder for your return as an investor. Mm-hmm. But I don't think we're at a crazy irrational place, although those financings do exist and you see them in the headlines.
Yeah. I've heard stories of, companies with no revenue, billion-dollar valuations, and then you can make arguments for either way, right? Like, is it worth it or is this just insanity? All right, so now it's time for 5 to Thrive. So basically 5 quick questions just to kind of pull some more knowledge out of your brain. What's one piece of advice that you'd give to somebody, say, 21 years old, interested in venture capital, and they say, look, maybe I graduated with a finance degree, or maybe I don't have a degree. What's the best way to get into the field? Maybe not as an investor, but as an actual job or something to generate income.
Sure. I think, I can speak from personal experience. Unpaid internships are great if you have an idea of what you want to do. But I think what I would say is become an expert. You have to add value to other people, right? And so no matter what field it's in, if you can show up at the door and say, hey, I'm an expert in, I know all the early stage tech deals in Los Angeles right now, or I'm an expert in over-the-top TV, right, and we're going to kill cable, and I know every company in the space. You have to come with knowledge that's in addition to what the people you're going to talk to may have. Okay. And I think it's really important to have an opinion. Doesn't matter if you're right or wrong. Nobody cares if you're right or wrong. People just care that you have an opinion. Yeah. And if you're somebody who's kind of a yes man and don't have an opinion and never take a stance, it's going to be hard to kind of get ahead in a sort of a competitive world like venture or private equity or other sorts of investing.
There you go, man. That's great. Are you in the camp that says focus all your energy on one source of income and one thing, or diversify and have multiple sources of income?
Look, I think unless you really know what you want to do with your life, you should keep as many doors open as possible, right? It's about optionality. And so I think it's never a bad idea to have eggs in multiple baskets, right? And so maybe have your own business on the side that's a cash flow business. Maybe work for the man in another occupation and get good benefits and things that come with that. But I think you really should, if you want to be in control of your own destiny, you really need to have a couple different, revenue streams.
Love it. Do you have a book that you would say is required reading for an entrepreneur or somebody that wants to get in the VC space?
I may take a pat. There's quite a few books that I think are really good. Look, I often joke that I have an economics degree, and I often joke I should have had a degree in psychology. So I think, the Malcolm Gladwell books are really helpful to kind of think about what's the right data set to look at, whether it be Blank or some of the others. I think technically, if you want to get into venture, there's a book called How to Be Smarter Than Your I think it's How to Be Smarter Than Your Venture Capitalist Lawyer and something else. It's about structuring term sheets and all the kind of gotcha terms. That's a much more technical book.
Gotcha.
But I think in general, books of self-improvement, psychology, decision-making, how to ask smart questions, those are going to make you better at anything you do and are particularly applicable to early-stage investing.
Great. Do you have a quote or a life mantra that you live by?
I would say impossible is nothing.
Nice.
Yeah.
Love it. And final question, what does true wealth mean for you or mean to you?
I think true wealth is about being in control of your own destiny. For different people, it might be a different dollar figure. For certain people, it might be a way of life or choosing their own way of life. But I think true happiness is not a dollar figure. It's a sort of state of mind. And so whatever that means for you to get to a point where you feel like you're in control of your own destiny, that could be financially, that could be lifestyle, that could be travel. But you really have to craft your life around what brings you happiness.
Nice. So what's next? Where do you want to take Nextgen?
So I think the vision is really we want to be kind of the premier partner early stage venture, right? And so we're going to be in hopefully 5 more cities in the U.S. soon and 3 internationally, as I mentioned. Mm-hmm. But I think the model we need to prove is that you can truly scale early stage venture capital in a way that hasn't been done before. And if we can pull that off, then I think we have a really, really special group.
Nice. Where can people connect with you?
LinkedIn's probably the best way. Unfortunately, I'm not the best at social media, Facebook, Twitter, things like that. I have all those accounts, but I'm more of a consumer than a producer in those formats. LinkedIn's the best way to find me. You can also probably get to me through the Nextgen Angels website. But happy to connect with folks and answer questions as they may pop up.
Nice. And what would you say is like a good candidate for Nextgen Angels or just angel investing in general, but specifically Nextgen? What type of guys and ladies are you looking for?
Look, I think a gating factor is being an accredited investor, right? So that's thing one. Beyond that, we're looking for people who are knowledgeable in tech and want to be part of an awesome network of other tech founders and executives and want to sort of make investments in the next crop of the next generation of successful early stage companies. So it's probably somebody in their 20s, 30s, 40s, have started a tech company in the past, work in a tech capacity at a large Fortune 500 or are sort of a prolific angel investor or who want to be one of those things. And sort of have the capacity to invest, 10, 25 grand a year into early stage companies.
Nice. I know one thing that really attracted me to the angel space is just being involved in entrepreneurship. It's like for anybody that loves entrepreneurship, I think the best way to be engaged is through the angel space because you see all the cool stuff that's coming down the pipeline. You get to understand the economics behind certain companies. And, I feel like where kind of my evolution as an investor is going is really trying to hone in on the industries that I understand and just putting my money there because, I've seen like some medical pitches and things that I'm like, dude, I have no clue how to even evaluate or where to start here. But, like on the Bitcoin space, I know you had the startup that came in and, so I'm just kind of trying to craft my own thesis and I appreciate all the work you're doing with Nextgen and looking forward to, seeing this thing grow over the next few years.
Great. Well, thank you for having me out. I really appreciate the time.
Yeah. Thanks, John.